Do you know how much money you need in order to be able to retire? It's a question that many people are asking themselves each and every day, and if you've seen my video on the 4% rule, you already know one of the most popular answers that will be given in response to that question. If you haven't seen that video, then in short, the 4% rule suggests that you need roughly 25 times your annual expenses saved in order to have a reasonably good chance of not running out of money once you leave the workforce. However, while I do believe that, on the whole, the 4% rule is a decent starting point and a solid rule of thumb to use as a guide, it isn't by any means the only answer to the question, and depending on your situation and goals, it may or may not even be the best one. Today we're going to be asking whether or not it's possible to withdraw more than 4% of your money every year in retirement, as we look at yet another popular retirement withdrawal strategy known as the Guyton Klinger method. We're going to be talking about what the Guyton Klinger method is, how to use it, the rules associated with it, as well as potential pros and cons associated with it in comparison to other retirement withdrawal strategies. Let's get started. Hey everyone, Daniel here, and welcome to Next Level Life, a channel where you can learn all about investing, debt, retirement, and many other financial topics besides, because let's face it, the schools aren't going to teach it for us. So if any of those topics sound interesting to you, or if you want to learn how to better handle your money and have more financial freedom, be sure to hit that subscribe button and the bell next to my name to be notified every time I upload a new video. And if you want to further support the growth of this channel, you can smash that like button if you haven't already, share this video with a friend, and leave a comment below letting me know what topics you'd like me to cover in future videos. So the Guyton Klinger method is just another retirement withdrawal strategy, just like the 4% rule, although it is a little more complicated compared to other retirement withdrawal methods because it has quite a few rules that need to be followed in various situations. So let's start by going over those rules. But buckle up because this is going to get pretty complex. The first rule of the Guyton Klinger method is known as the withdrawal rule. Interestingly, the Guyton Klinger method actually begins very similarly to the 4% rule, with you setting a certain percentage as your target withdrawal rate for each year of your retirement. However, unlike the 4% rule, which adjusts your withdrawal amounts each year for inflation regardless of external factors, you will only adjust your withdrawal amounts using the Guyton Klinger method for inflation in the years where your portfolio's total return was positive. So in other words, if your investments lose money in the previous year, then you will not adjust for inflation. And you don't make up for missed inflation adjustments in the following years, even if your investments are making money again. So say if the market crashes and you lose money for 3 years in a row, but then it bounces back and you gain money for 5 years in a row, you'll adjust for inflation in those 5 years that you gained money. But that first year you gained money, you're not going to adjust for the previous 3 years as well. You're only going to adjust for the 1 year, the year where you made money. Additionally, the maximum adjustment that you can make each year for inflation is 6%, at least under the original rule, although some studies examining this rule have chosen to ignore this. So if inflation causes costs to rise by 8% one year, which does happen some years, thankfully not often here in America, but some countries have, and your investments are performing well enough for you to adjust for inflation, you can't actually raise your withdrawals by 8%. You can only increase them by 6%. This means that under those circumstances, even though you adjusted for inflation, you will still lose some of your buying power, following this rule as it was originally written. The second rule of the Guyton Klinger method is known as the capital preservation rule. I mentioned this last week, and this rule seeks to ensure that you aren't withdrawing too much of your nest egg so that you run the risk of outliving your savings. The rule itself basically states that if, at any point, your withdrawal rates increase beyond 20% above what your initial target was set to when you were going through the withdrawal rule, then you will lower your current year's withdrawals by 10%. The third rule of the Guyton Klinger method is known as the prosperity rule. This rule is basically the reverse of the capital preservation rule, as it seeks to ensure that you aren't withdrawing too little of your nest egg, that you run the risk of drastically lowering your standard of living over time. Basically, it states that if at any point your withdrawal rates decrease beyond 20% of what your initial target was set to in the withdrawal rule, then you will increase your current year's withdrawals by 10%. And I should mention that whenever either of these last two rules are triggered, the adjusted withdrawal becomes the new base withdrawal that we use in all following years' withdrawal calculations. And this may seem a little bit odd and might be a little confusing, but it'll make a little more sense in a minute when we get to see them used in an example. For now, just think of these two rules like financial guardrails. They help prevent the value of your nest egg from falling off the edge of a financial cliff, and they help you to maintain a majority of your original standard of living through the ups and downs of the market over time. That's basically what they're there for. I should also note that according to Jonathan Guyton and William Klinger, the creators of this rule, the capital preservation and prosperity rules don't necessarily have to be followed in the final 15 years of your planned investment period, which for most of us will be our retirements. Though due to the uncertain nature of retirement lengths, none of us know when we're going to die, many people still do choose to follow these rules throughout the whole process as an added safety measure. The fourth and final rule of the Guyton Klinger method is the portfolio management rule, which is basically a sort of rebalancing formula, with the main idea being that you should withdraw money from the gains of your nest eggs in order of best to worst performance over the previous year, and, if applicable, move any excess gains that you may have into a cash account for next year's withdrawals. Technically, the full rule is a little more comprehensive than that. It states that you should withdraw your money in the following order. First, any equity classes that are considered overweight from the previous year. Second, any overweight fixed income assets from the prior year end. Third, any cash you may have accumulated. Fourth, any remaining fixed income assets you may have. And finally, fifth, any remaining equity assets in order of best to worst performance from the prior year. And if at all possible, no withdrawals are taken from any equity assets following a year in which that equity had a negative return. Instead, you would withdraw from cash or fixed income assets. So that's the full rule, but the main idea is roughly to draw money from the overweight assets, the ones that gained the most, first, and then move any excess that you may have into cash so that it can be safely used to help fund your withdrawals in future years. Based on my research for this video, it seems as if this last rule has some controversy surrounding it. It's very complicated, and based on the majority of the studies that I found, it doesn't even necessarily always significantly improve the success rates when it comes to not outliving your money. So some have suggested that it's actually more trouble than it's worth, but I'm mentioning it here because it is still technically part of the strategy. But like I said, this method is very complicated compared to its contemporaries, and it is very confusing without an example, so let's take a look at how this method would work in action. Let's say that John has $1 million saved to start his retirement. The first thing that he needs to do if he's following the Guyton Klinger method is to set his initial target withdrawal rate, so that we can follow the withdrawal rule. Since we're trying to do better than the 4% rule, let's say that John's target withdrawal rate in retirement is 5% per year. That would mean that in his first year of retirement, he would withdraw $50,000, or 5% of his total nest egg, leaving him with a new nest egg of $950,000 at the end of the year. Next, we have to make sure to check that John's yearly withdrawals, in this case $50,000 for the year, is not lower than 4% of his total nest egg, or higher than 6% of his total nest egg, since if his withdrawal rate was lower than 4% of his total nest egg, it would mean that he had reduced his initial target withdrawal rate by more than 20%, and if it's higher than 6% of his total nest egg, it would mean that he increased his initial target withdrawal rate by more than 20%. This is basically how we check the capital preservation rule and the prosperity rule. But since his total nest egg was $1 million to start the year, and he only withdrew $50,000 of it, he withdrew 5%, which means we're in between those 4% and 6% guardrails, so we're okay. Now let's assume that John's investments grow by 10% over the course of that first year, bringing the value of his nest egg up to $1,045,000 at the start of his second year of retirement when he's getting ready to make his next withdrawal. Since his investment returns were positive in the first year of retirement, he would be allowed to adjust for inflation. So let's say that inflation was 3% during John's first year of retirement. This would mean that after adjusting for inflation, John would withdraw $51,500 to live on for his second year of retirement. But remember, each and every year we need to check to make sure that John's withdrawal amount, which is now $51,500, is inside those 4% and 6% guardrails. So we take his annual withdrawal of $51,500 and divide that by his current retirement nest egg before the withdrawal, which was $1,045,000, and we see that he is withdrawing about 4.9% of his total nest egg. That's well within the financial guardrails we set for ourselves using this method, so we're good to go. John withdraws $51,500 from his investments, following the portfolio management rule we discussed a minute ago, and we look forward to year 3. John's investments continue to perform very well in his second year of retirement, rising by 20% this time. And his real return is pretty good too, with inflation only being 2%. This means that John's nest egg is now worth $1,192,200 before he makes his third year's withdrawal. And since his investments were positive, he is able to adjust his withdrawal for inflation in his third year, which means his new withdrawal would be $52,530. Once again, we have to check for those guardrails. $52,530 divided by $1,192,200 times 100 to get it to a percentage is well within those guardrails, so we're good to go. However, thanks to some more phenomenal investment performance in John's next year of retirement, he's actually going to finally need to make some adjustments to his withdrawals based on the prosperity rule. With a 25% return on investment and a 3% rate of inflation, John has had his best year yet. His nest egg is now sitting at $1,424,587.50 before he makes his withdrawal. And his next withdrawal, if we adjust for inflation, is set to be about $54,100. However, when we divide 54,100 by the 1.4 million, we see that John's withdrawal rate is a shade under 3.8% of the total value of his nest egg, which means we've actually fallen below our 4% financial guardrail, triggering the prosperity rule. This means that John will increase his anticipated withdrawal by 10%, which would bring his actual withdrawal for the fourth year of retirement from $54,100 all the way up to about $59,500. This brings us back above that 4% financial guardrail, and we're back on track. And remember, whenever the prosperity or capital preservation rules are triggered, we use the new adjusted withdrawal, in this case $59,500, as the new base withdrawal for future inflation adjustment calculations. So if John's investments continue to perform well and he gets to adjust for inflation next year, he'll be adjusting based on $59,500. Not $54,100. But unfortunately for John, that's not going to happen this time, because with the ups in the market, eventually come the downs, and John's not likely to sustain returns of better than 20% forever. He learns this the hard way when the market tanks the following year, losing a whopping 30% of its value and bringing John's nest egg down from roughly $1,365,000 after he made his withdrawal last year to $955,500 before making his withdrawal this year. And remember that since John lost money this past year because the market tanked, there are a couple of rules that are going to be triggered. The first is that he can't adjust his withdrawals for inflation, regardless of what inflation is that year, and he won't be able to make up for that lost adjustment in future years. This means that his anticipated withdrawal of $59,500 isn't adjusted for inflation, but what's worse is since his investments lost so much value in such a short amount of time, his withdrawals are now actually above the upper financial guardrail of 6% of his total nest egg. Therefore, he will need to adjust his withdrawals down by 10% to get himself back on track. This means that his actual withdrawal for his fifth year of retirement will be about $53,550. Let's say that inflation was 5% during year 4 of his retirement and 2% in year 5, with his investments growing by 15% in that fifth year, recovering at least some of his losses from the previous year. And now let's pause for a minute and look at the situation for John. In his first 5 years of retirement, his investments have averaged a return of about 8%. And after taking into account his withdrawals, the value of his nest egg stayed pretty steady despite having a year where the market tanked by 30%. Which is admittedly pretty encouraging for those worrying about running out of money in retirement, especially considering that we started off withdrawing 5% of our money, instead of a more conservative 3 or 4% that we usually hear about. However, I regret to say that not all is sunshine and rainbows in this scenario. John's anticipated withdrawal to start off his 6th year of retirement after adjusting for inflation would be $54,600 under the Guyton Klinger method, but this is where we see the first potential con to using this method. Under a different retirement withdrawal strategy, such as the safe withdrawal rate, we would be adjusting our withdrawals every year for inflation regardless of market performance, as opposed to only when our returns are positive, and as a result our withdrawals would be higher than they were in John's example. all else being equal. Let me explain. Assuming that John were following a 5% rule, as opposed to the more traditional 4% rule for no other reason than just to keep things consistent between the two methods, and the returns and inflation that he experienced stayed the exact same as we just went over, John would be withdrawing nearly $58,000 in his 6th year, which translates to about $280 a month in extra income compared to what he had using the Guyton Klinger method. And this is only after the first 5 years. As you can imagine, depending on the performance of the market, John's buying power could slowly erode due to these freezes, reductions, and inflation over time, at least when compared to a more buying power focused withdrawal strategy like the safe withdrawal rate. The other side of that coin, though, is if John were following a 5% rule, wouldn't his nest egg be worth less than it was under the Guyton Klinger method, all else being equal? Well, as it turns out, no. At least not with the numbers we used in this particular example, but they are very close. John's net worth under the 5% rule after this 5-year period would be $1,037,900, while it was $1,037,300 under the Guyton Klinger method. Though this may very well be misleading due to the small sample size, we've only looked at 5 years here. If all else is equal, and John is withdrawing less money each year using the Guyton Klinger method than he is using the safe withdrawal rate, then eventually the value of his nest egg using the Guyton Klinger method will have to surpass the value of his nest egg under a safe withdrawal rate. So while the Guyton Klinger rule, complicated as it is, does give you a reasonably certain chance of not outliving your money in retirement, and all else being equal, arguably more so than the safe withdrawal rate does, it may do so at the risk of noticeably cutting your buying power, especially in less than ideal times. So the question that you need to ask yourself is, just like with all of these strategies, which of the 4 factors of retirement do you value the most? Which do you value the second and third most? And which do you value the least? For those of you new to this channel, I've already done a video called The 4 Factors of Retirement, which is kind of a precursor to all of these retirement withdrawal strategy videos. I highly encourage you to check it out. I'll leave a link in the description below if you haven't already. But the factors are maximizing withdrawals, or in other words, income, especially in retirement, limiting or completely eliminating the possibility of running out of money, which I refer to as risk, avoiding any undesired changes to your income stream, namely reductions of it or freezing on it, which we saw in this video. This I call the stability factor, and maintaining your purchasing power or buying power, which we also just went over. Answering these questions for yourself is what will ultimately help you to decide whether this particular retirement strategy is the best strategy for you. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.